John Linehan, you are taking over the T. Rowe Price Equity Income Fund. It's a $23 billion fund at the end of the month from Brian Rogers. So what are you going to do once you finally get the keys to the car?
Well, stylistically, I wouldn't expect to be a significant difference between how Brian invests and I invest. We both have a relative value orientation, yield focus, and somewhat of a contrarian approach to investing. That being said, I'm going to be my own person. I've actually taken over a portfolio from Brian about 12 years ago. I've learned from that. I think you should expect to see some different names, but the longer-term tenets of a long-term investment philosophy, focus on names that we think have valuation appeal will still be there.
And the fund you took over from him last time was the value fund, and you're a value guy. Value has underperformed growth for the past year, 2 years, 5 years. Why will next year be different?
I'm not sure next year will be different, but I think value makes a lot of sense for individuals in terms of constructing a portfolio. If you look longer term, value has outperformed growth. Typically in a rising rate environment, value will outperform growth. And this is a market that's been dominated by a number of companies, very selective market at this point in time. I think going forward that breaks, and when it breaks, I think value will do fairly well relative to growth.
And one stock you like is Loews Corporation. This is a conglomerate that owns insurance, they own hotels. They also own Diamond Offshore, which is a driller, which has really dragged down the stock of late. I think it's down 14% for the year. So what's going to turn Loews around?
Well, I think right now there's a misperception in the investment community. Diamond Offshore is only about 15% of the asset value of Loews. It's trading at a 20% discount to its sum of the parts. I think just looking at the underlying value makes sense. They have they own over 90% of CNA. I think that's an attractive investment in its own right. They're trying to rebrand not rebrand, but they're trying to basically change the business model for their hotel portfolio. So I think there's a lot of change underfoot, and we think it'll be a good stock longer term.
And you're also positive on Apache to stay in the oil patch. This has really had problems this year. I think it's down over 25% so far this year. How high does oil or natural gas have to go to bring Apache back up?
Well, obviously, the higher it goes, the more it's going to come back up. But we like Apache even at these levels. And the reason we like it is we think they have a very strong position in the Permian Basin. They have a very strong balance sheet. And I think they have the opportunity to do a lot of self-help in terms of cost cutting. On the other hand, if oil prices stay at these levels, at some point you'll see consolidation in the oil patch. And we think Apache could be a prime takeout target.
And then finally, you like DuPont. Nelson Peltz has pushed out Ellen Kullman. That's popped the stock a little bit. How much higher can it go with his pushing? He's there. He's got what he wants. What happens now?
Well, I think what happened with Ellen is there is a resistance to change there. If you look at DuPont, there's tremendous opportunity for internal improvement. Peltz has talked about a $1.8 to $3.8 billion cost-cutting opportunity. If you take the midpoint of the range, that's a significant improvement to DuPont's earnings, and we think it's not reflecting the stock price at this point.
All right. Well, thanks a lot, John.
Thanks so much. Great seeing you.
And thank you for watching The Street.